Have you ever wondered how a decision made in Washington DC could actually affect the price of your chai in Mumbai? It's all part of this huge interconnected economic dance. And today we're going to unpack that whole dance by focusing on just one single powerful number, 90.05. So in December of 2025, this was the number. This is how many Indian rupees it took to buy just one US dollar, a record low for the currency. So was this a disaster, a golden opportunity, or as is usually the case, something way more complicated? Let's get into it and unravel this economic mystery. All right. So to really understand the why behind all this, we got to get a good handle on the what first. Let's break down what it actually means when we say a currency is falling. What we're really talking about here is rupee depreciation. Now, this isn't some top down decision made by the government. In a free floating system like India's, it's the natural outcome of global market forces. You know, literally billions of transactions every single day that determine the balance of supply and demand for the currency. Now, this is a really crucial point. We can't confuse depreciation with devaluation. They sound similar, but they are worlds apart. Depreciation is totally market driven, it's just supply and demand at work. Devaluation, on the other hand, that's a deliberate official move by a central bank to push a currency's value down. What's happening to the rupee? That's pure market dynamics. So, when you see a number like this, should you be worried? Well, what's so fascinating about economics is that it's not automatically bad news. A weaker rupee is a classic double edged sword. It creates some clear winners and some clear losers right across the economy. So, this really is the big question, isn't it? Does a falling rupee mean a weak economy? I mean, it's easy to jump to that conclusion, but the truth is a lot more nuanced. India's core economic growth is actually pretty strong. So, this isn't really a story about domestic weakness, it's a story about some really powerful global pressures. Okay, let's look at the tough stuff first. For a country like India that imports something like 85% of its oil, a weaker rupee means you're paying more for every single barrel. And that cost, it gets passed on to you and me, which fuels inflation. It also really hurts companies that borrowed money in dollars because their debt just got more expensive to pay back in rupees. And of course, anyone planning to study or travel abroad feels that pain directly in their wallets. But wait, that's only one side of the coin. On the flip side, if you're an exporter in India's massive IT or pharmaceutical sectors, guess what? Your products just became cheaper and way more competitive on the world stage. For the millions of non resident Indians sending money home, their dollars now magically turn into more rupees, giving a real boost to their families. It's a powerful tailwind for anything made in India. So you've got these two powerful forces pulling in opposite directions. Pain for importers, but big gains for exporters. How on earth does a central bank, like the Reserve Bank of India, navigate this incredibly tricky balancing act? You know, the RBI was really at a crossroads here. The traditional playbook to stop a currency from falling is to jack up interest rates. But here's the catch, raising rates can really slow down economic growth. So the choice was pretty stark. Do you defend the currency or do you protect the economy? And they made their choice. They went for what's called a dovish pause. Basically, they kept their main policy rate, the repo rate, which is just the rate they lend money to banks at, unchanged. This was a clear signal that for right now, they were putting economic growth first, ahead of trying to strengthen the rupee. So, how could they make a call like that? Well, the answer is sitting right here in their own forecast. Take a look. For the 2026 fiscal year, they were seeing strong growth, but, and this is the crucial part, they predicted inflation would drop all the way down to 2.6%. With inflation looking that tame, the RBI had what it calls policy space. Basically, it gave them the wiggle room to focus on growth. The bank is essentially betting that keeping your loan payments manageable is more important right now than making your trip abroad a little cheaper. But here's the thing, the RBI isn't making these decisions in a vacuum. A huge, massive piece of this puzzle is located thousands of miles away in Washington, D.C., inside the headquarters of the US Federal Reserve. Think about it, when the US central bank, the Fed, raises its interest rates, it makes the dollar way more attractive to global investors. So they pull their money out of emerging markets like India to go chase those higher returns in US assets. This massive sell off of rupees and the global rush for dollars is one of the single biggest reasons the rupee has been falling. And listen, this isn't just some theory. The Fed's own research backs this up. This quote is about as clear as it gets. When the Fed gets hawkish, meaning it gets really aggressive about raising rates, it's not just an American problem. It causes a substantial slowdown across all emerging markets. But here's where it gets really interesting. The research makes this brilliant distinction. Not all US rate hikes are the same. See, if the Fed is raising rates just because the US economy is booming, that can actually be a good thing for other countries. But if it's raising rates aggressively just to smash inflation, what they call a hawkish tightening, that's when it causes a major slowdown everywhere else. The why behind the hike makes all the difference in the world. Okay, so these economic waves from US policy, they hit everybody, but they don't rock every boat in the same way. A country's own economic vulnerabilities are what really determine just how choppy the waters are going to get. And there are two big vulnerabilities to watch for. First, how much debt does a country owe in foreign currency, especially US dollars? The more dollar debt your companies have, the more pain a falling local currency is going to cause. And second, how anchored are inflation expectations? In simple terms, do people actually trust that the central bank will keep inflation low over the long run? This chart right here shows you exactly what that looks like. The blue line, that's economies where expectations are anchored. People are confident inflation will stay low. But that red line, that shows the more vulnerable economies where expectations are higher and all over the place. For those countries on the red line, a tiny spark, like slightly more expensive imports, can risk starting a full blown economic wildfire. So, what does this all mean for that number we started with? 90.05? It means that the value of the rupee is never ever just about India. It's a really complex dance between the RBI's choices at home, the country's own economic health, and maybe most powerfully, that long shadow cast by decisions made at the US Federal Reserve. Which really leaves us with a huge question for the world we live in today. As these economic waves travel instantly across borders, how much control does any single nation truly have over its own destiny?